You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. And today is, it's after Thanksgiving. Hope you had a great Thanksgiving. I certainly am thankful for you and your support. I've been doing this podcast now for over a decade, and I can't tell you how much it means to me that you've supported me and my efforts through, both good times and bad, because, that's the nature of a show that has been around this long. In the world of investing, we have cycles, and this is an investing show. So if you stick around long enough, you'll see it all. And by now, we most certainly have. When I first started this podcast, it was just a few years, like three or 4 years, right after the mortgage meltdown of 2008, 2009. And no one was excited about investing in real estate at that time. But those of us who did actually really killed it. We killed it, right? We had several years of a real estate bull market that ultimately culminated in the frothy COVID era markets. Then, of course, as interest rates skyrocketed, we saw the bottom fall out. And now it's like 2012 again. The market's bottomed out. The smart money recognizes it, is moving in. But guess what? Just like before, retail investors are scared and probably won't join the party for a couple more years. And then the market will be really hot. And guess who jumps in? Yep, retail investors. History doesn't repeat itself, but it certainly does rhyme. And, that's why it's important to take note, to try to not make the same mistakes again. And also to note when you could have done something that you didn't do, right? I mean, that's really what it's about. I've had plenty of those lessons in the last 15 years or so. And, sort of in the spirit of that idea, I thought I'd make a short list here of lessons I've learned over the years, and hopefully it'll be useful to you. After all, the best way to learn is through mistakes. That's always the case, but they don't always have to be your mistakes. They can be mine. And I feel like overall I've been very, very fortunate in that I have done well. But if you're going to be a hands-on investor, you're going to have ups and downs. And the reward here of being, committed to being involved with your finances is that all you need to do is have more wins than losses. And over a period of time, you can do that if you stick to some principles. Here, I'm going to give you a few things, just a few thoughts. Some of them are obvious, but I'll just emphasize again. One of them, number one, I would say, is quit while you are ahead. Okay. No bull run lasts forever. If it looks like everyone is making money and it seems too easy, you might be in a market that's at its peak, and it might be time to sell. We certainly saw this, in the last couple of years. But back in 2008, there were stories of strippers buying multiple mansions and flipping them here in California. And of course, strippers aren't necessarily known for having the best credit scores. So obviously the subprime market was in full gear, and the market came crashing down soon after that. And in 2021, 22, of course, recently everyone became a real estate syndicator, right? You saw everybody was making money as a real estate syndicator, buying up hundreds of millions of dollars in real estate, doing nothing to that real estate, and then ultimately winning because the market kept going up. The other thing that in hindsight I could say is true is that, you start seeing tertiary markets get hot. When I say tertiary markets, it's markets that don't really fundamentally have any reason to get hot and expensive. And a good example of that was Oklahoma City. There's no reason for Oklahoma City to get hot, but it got hot because of its proximity to Dallas-Fort Worth. That only happens in frothy markets. So you got to, keep an eye out on that. And if you see it happening again, stop buying and become a net seller. Another lesson is something that I've sort of been talking about quite a bit lately, which I think is important, which is be greedy when others are fearful. That's a Warren Buffett quote, of course. A good friend of mine he is a former, I should say, celebrity home builder in LA before the 2008 financial crisis. Had made millions of dollars, in his 30s, and was really, really successful. But and then 2008, lost everything because he was over leveraged, which is another thing to avoid. By the way, it didn't make the list, but being over leveraged is something that should have made the list. He lost everything because he was over levered. But he had his rational brain still on. And at that time had noticed that hotels, the kind that you stay in, overnight, that kind of hotel, those were being sold at massive discounts. And he tried to raise money. He told me he went back to the same people who, wanted to invest with him on these homes and said, "Hey, this is a once in a lifetime opportunity to invest in hotels. And I think we can make a lot of money." And guess what? Nobody wanted to do it. And he fortunately was able to scrape enough money together to start, slowly but surely buying up in the hotel space. That culminated ultimately with he's still got some hotels, but with a $100 million sale for him last year. And again, none of that would have happened if he hadn't taken action when others would not, right? And again, that is the situation I'm talking about, is to try to overcome fears and understand when you are at the bottom of the market, then it is time to buy. Another lesson in general related to this is that there's always something on sale, okay? Now, this is something that, I have to keep reminding myself too, because our built-in psychology makes it hard to be good investors. I'll be the first one to admit I've been the victim of my own instincts before, and I try to fight them hard. Back in 2017, I believed, and I still believe, that Bitcoin will eventually become a sort of digital gold, and I knew we would see $100,000 Bitcoin at some point. And of course, we're just lingering right around 100,000. It might be 100,000 by the time I release this podcast. At the time, it was priced at about $3,000, and it was was going back and forth between 3,000, 6,000, around that area. And I truly believe we'll see $500,000 Bitcoin by the end of this decade. Now, you'd think I would have accumulated Bitcoin every time it got slaughtered, right? Well, I did, but the problem is that, for example, in 2017, I actually had quite a bit of Bitcoin, but then we hit this crypto winter, right? Bitcoin was lows, lots of capitulation in the market. And that got me to capitulate as well, in part because, it was a few years of just low prices, and it just seemed like, well, gosh, I could probably just jump back in here later. I sold all the Bitcoin I had, which would have been worth, several $1,000,000 right now, and invested in other things. Now, I did make money on those other things because, frankly, they were in real estate, and that was still a really, really excellent time to invest. And there was still ample runway, but I didn't, I didn't make nearly as much as I would have simply by holding to my convictions and holding on to the Bitcoin I had. Luckily, though, my dad was making the same mistake a couple of years later, and he wanted to sell, and I had bought it for him, so I was custodying it for him. And I said, "You know what? I'll just buy it from you, Dad." So I bought it. It wasn't nearly as much as I had, but I had some. I bought from him, and well, gosh, it has 10. It has gone up a lot. By then, I think I bought it from him around $6,000, and again, we're at nearly 100,000 right now. So, sorry, Dad. That's but that's what you wanted to do, and I took it off your hands. So, anyway, again, so the moral of the story is, when things are, when they're on sale, they can seem less exciting, right? And you don't want to chase exciting. You want to chase kind of like something that's not exciting. It might be, more on the boring side. And right now, real estate is on sale. That's what happens when you get into a market where, there's been massive liquidations and that kind of thing. Is there's a booting of prices, and that's what's going on in real estate. And that's why, despite the last couple of years where the real estate market has been tough, and it's hurt me as well, I don't want to make the mistake of not buying now. So that's the lesson here for me. Now, as a corollary to my Bitcoin conversation, I will tell you again, I am convinced on Bitcoin moving up quite a bit. So as a corollary to that last rule about there's always something on sale, and how, my story about Bitcoin, I'm just going to throw in this rule. I will do everything I can to hold on to my Bitcoin. So don't sell Bitcoin is that rule, regardless of what happens in this market, until I see Bitcoin go on par with the market capitalization of gold, because that's where I think it's going to be. And when that happens, I think what will happen is Bitcoin it will become like gold, where, it is not nearly as volatile. And so the opportunity to make a lot of money becomes a lot less, right? It won't go up at the same rate. Now, that market capitalization would be approximately $900,000 per Bitcoin. So when it hits that, again, I believe it's going to stabilize and behave like gold, which means I'm open to sell it. So that's what I'm looking at, $900,000 Bitcoin. Now, the next lesson, of course, we're talking about real estate, we're talking about cryptocurrency, but the lesson is there's more to life than real estate and cryptocurrency. And again, these are rules for myself, so that's why I'm focused on them. And so hopefully they'll be useful for you too. I've made money in other ways when I followed, the rules that I've talked about before, all the other 4 other rules that I mentioned. The thing is that it doesn't have to be in real estate and cryptocurrency. It can be in a number of things. For example, a couple years ago, the uranium market was beat up, right? So I bought some uranium royalty stock in a startup because uranium was beat up and it was on sale. Now, right now, uranium is in the early stages of a bull market, and arguably maybe I should have held, but the stock I owned was up 10x. So, or I was actually maybe even a little bit more than that, but I sold it. By the way, never be apologetic for making a profit, locking in a profit, right? You can be sad that you sold too early or whatever, but if you made money, be happy. And there's no rule against that. So the moral of the story is, again, keep your eyes open for anything on sale. And when you buy, be patient. That's the thing, is like this uranium play even took, is it a couple years, but I think I must have bought that 4 years ago or something like that. And 3 or 4 years ago. And it's been a while, right? Where it's like 2020 or maybe it was 2019 when I bought this. And well, guess what? That market, the uranium market, was dead all throughout that time, but there was good indication that there was going to come alive again because of the things that are happening. By the way, uranium, in my view, is still a very good play. Reason, you might not see the connection here, is artificial intelligence, because these AI technologies take up enormous amounts of energy. I don't know. So if you can invest in like Canada, where there's a lot of natural resources for energy, or in general, uranium, I think, for nuclear power, I think that's where we're headed. Anyway, once you buy something like that, though, you got to be patient. And that's what happened to me when I was sitting on Bitcoin that was not moving, and it seemed to be cheap in this market that was a bear market. Eventually, though, markets, if you believe in your convictions, the markets should turn, and then there's nothing like selling it into a frothy market. Feels great. Okay, the last rule I'm going to give you, because we have an entire podcast to get through here, an interview, is don't let the tax wag the dog. Okay, what I mean by this is a nuanced rule, and I continue to struggle with, because as a real estate professional, I find it very difficult to invest in things outside of real estate because of the massive tax benefits I receive. But sometimes markets get frothy and you should not invest in real estate, even if it's a tax benefit to you. And sometimes the price of Bitcoin or uranium, as we discussed before, or any other asset, goes on sale and it's hard to beat. So in those situations, buy what's on sale, right? Even if it means foregoing those huge tax benefits. I'm not saying to ignore them, but it's important to keep open to them, because I will say it probably is another reason why I didn't continue to accumulate as much Bitcoin as I would have liked, because there's no tax advantage to me to buy Bitcoin. So I just kept investing in real estate, knowing that I could just write off, the majority of what I was investing. It's a great deal, right? But if I had invested, maybe 10 or 15% of what I invest in real estate, I would be very, very happy right about now. So, again, while taxes are an important consideration, don't let them be the only factor in your decision-making process. And again, I have to constantly remind myself of this as well. So, again, I'm not perfect at all, and I will continue to make mistakes. But fortunately, I seem to get it right more than I make mistakes, and that's worked out for me. So there you have it. There's at least 6 important lessons I've learned, and hopefully they'll benefit you too. Now, speaking of not letting the tax wag the dog, though, this week's episode of Wealth Formula Podcast, it's all about taxes, specifically the likely changes under the Trump administration. And while we don't, as I said before, want to let the taxes always wag the dog, we also don't want to be foolish, because knowing what's likely in store on the tax front is enormously critical to financial planning, whether it comes to, tax mitigation strategies for the year, but also even estate planning, any number of things. So it's incredibly important that you know about it. So make sure you listen in. This podcast is really good, and there's some really critical issues that are brought up that you need to know about. So listen in, and we'll be back with that interview right after these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Garrett Watson. He's a senior policy analyst and modeling manager at the Tax Foundation, where he conducts research on federal and state tax policy. His work has been featured in the Washington Post, the Atlantic, Politico, and the Associated Press, and of course, other major outlets as well. Garrett, thanks for being on the program.
Thanks for having me.
Yeah, so, we obviously this tax is a big topic as we sort of enter this new era of Trump 2.0 and the administration coming in January. Let's start with this. What tax cuts are currently on the table for 2025?
So as we head into 25, I think the big story here is we are dealing with the long-term fallout from the 2017 tax law. So at the end of 2017, Congress, led by a unified Republican government, had a major tax reform and tax cut amounting to several $1 trillion of tax cuts over the last 8 years. That included both individual and corporate tax changes. It was the biggest set of tax changes since 1986. It was a signature part of then President Trump's agenda passed in December of 2017. And that, generally speaking, cut taxes across the board for most American families and taxpayers. The big twist, though, was while many parts of the tax law were made permanent, the major aspects of the 2017 tax law, the changes to the rates and brackets that were a tax cut for many people, the doubling of the standard deduction, the increased child tax credit, among many other things, they were all made temporary. So they are scheduled all to expire at once in what we may call a tax cliff at the end of 2025. And so that's really going to motivate Congress and President-elect Trump to come together and deal with that. They're really pushing, of course, to extend or make permanent that tax law that Republicans see as having a positive effect on the economy and, of course, keeping taxes lower for Americans. But they're going to have, of course, a lot of challenges doing that, I'm sure we'll chat more about. In addition to that, of course, President-elect Trump did run on a series of additional tax cuts, ranging from tax exemptions on tips, overtime work, Social Security benefits. Those will have to be addressed as well. The other big wild card, of course, that's been talked about a lot during the campaign is the specter of increased tariffs, which the president-elect is a big fan of, is now staffing up to address. We'll have to see how that plays in on the revenue side, how that may affect Americans, whether or not it's done through Congress. Lots of open questions as we head into next year.
Well, let's kind of go down the line. I mean, there's a lot of real estate investors listening to this. And one of the things that we benefited from over the past several years is bonus depreciation, accelerated bonus depreciation, where typically the personal property component of real estate that you would generate through a cost segregation analysis used to be 5 years, and we were able to take it initially all in the first year, which is 100% bonus depreciation. Then it went down to 80. It's at 60 right now. And next year, I guess, would be 40.
That's right.
Do you see that as a target of potential extension?
I think so. It will be a big priority particularly for Republicans who see it as a big engine for growth. So as you said, under the 2017 tax law, starting in the fall of 2017 and going through the end of 26 when it fully phases out, that bonus depreciation provided that backwards 100% full immediate expensing for those short-lived assets and investments, many of which could apply through cost segregation and other strategies for real estate investors and owners. And so that was scheduled, like the individual provisions, to be temporary, to phase down. It'll be gone completely at the end of 2026. In addition to that, there's also R&D expensing. You have to amortize those expenses over 5 years now domestically. That may come into this conversation. There's also a tighter interest limit for folks engaged in debt financing of investments that may be reversed. Those three major business changes were part of that bipartisan tax bill that failed to pass in the Senate this year. So there's actually some interest on a bipartisan basis to bring some of this back. I think the big question mark for bonus in particular, and for these other provisions, is the question of what might the extension look like. Because it's a timing change, of course, for taxpayers. Sort of in the short run, if you extend it over 10 years, say, it can be costly for the government. There's an incentive to make it temporary. So it's possible we'll see it extended over 2 or 4 or 5 years. With the trade-off of it may look cheaper on the scoring, but that might mean we have to go through this again in a handful of years. I think the thought was when they made it temporary before, and this is true of the individual provisions too, that that Congress would not fail to extend it. Well, in the business side, that's not been true, right? With R&D, it expired at the end of 2022. With bonus, it's phasing down, and there hasn't been a successful bipartisan effort to reverse that. So hoping that next year that'll be done.
There was something that of the bill. There was a bill in front of Congress, and it sounded like, and this was essentially to not only go back to, I guess, 100% bonus depreciation, but also to make it retroactive to the year before, which, obviously from investors like us, we're like, wow. And on top of that, that was fairly, from my understanding, kind of a bipartisan thing. Can you talk us through that? And maybe two things. Why would the traditionally sort of not so pro-business Democrats be interested in participating in that and supporting that, but also what ultimately made it fail?
Yeah, those are good questions. As you said, a lot of there are many aspects of that bipartisan tax bill that were going to apply retroactively back to, I think, as far back as 2022. And part of that had to do with the fact that there was this understanding on the part of many policymakers that businesses were expecting and hoping that this was going to get addressed years ago. And so there's some trade-offs of retroactive policy, of course. It doesn't change behavior moving into the future. It can be more expensive. But that was sort of an effort to try to make those folks whole who maybe had every reason to believe it was going to be extended, but it wasn't. And there was this, maybe a little bit of a cash crunch for certain investors. And so that was, one aspect of the bill that probably did get a bit more skepticism particularly from some Democrats who were skeptical of the retroactivity, though that wasn't the main driver of why it failed. So at a very high level, there were several drivers, of course, but it did pass, I believe, in the either late spring or early summer, I believe, the House by a pretty large margin on a bipartisan basis. And then it went to the Senate where it promptly died. It did get a vote, but it failed, I believe, on the floor. And that had to do with a couple of things. One was the business changes, including extending bonus depreciation, were paired with changes to the child tax credit, making the child tax credit refundable, changing the way in which you calculate the credit for low-income families, and that was subject to some partisan division. Leaders in the Senate in particular weren't super jazzed about that part of the bill, and so that was probably the major sticking point for folks that allowed it to fail in the Senate, because it was, for Democrats, it was part of the deal that, hey, we're going to address these business provisions, but we want something on tax policy for families. And those child tax credit changes were part of that. The problem was they couldn't, between both chambers of Congress, get to a mix of policies where you got sufficient support that it could pass both chambers. So that's ultimately, it was that combined with the fact that as you got further into this year, electoral considerations start becoming a bigger and bigger part of it. And there was a sense that, hey, if we were to, if Republicans were to get full control or Democrats were to get full control, they can do whatever they want. subject to reconciliation and other limits next year. Why not just wait? And in some ways, I think some of those folks calling for that on the Republican side probably feel vindicated because that's exactly what's going to happen
Yeah.
with unified control. And so
So that one seems like a no-brainer, right? I mean, that seems like
Right.
that's going to happen. I mean, it almost already
Yes.
happened before, and now there's nobody to get in the way of it at all. Just as and that do you for the same reason, I would think that you would anticipate this would be a retroactive type bill again. Yeah, for this year.
Yeah, I think that's one open question is, do they revisit that? I mean, now that they've had a bill where there is some retroactivity, it'd be hard to go back and say, okay, we're not going to do that. It
Yeah.
also is only marginally more expensive to do that relative to the very big numbers we're talking about otherwise. So that I wouldn't be surprised if a design very similar to what we saw in the bipartisan tax bill was carried forward into next year and maybe extended a little further out.
Yeah.
I think that's one balancing act is how much can they make permanent? One thing we're pushing is it would be great to get bonus permanent for certainty, and because in our estimates and our modeling, we find it is a big pro growth driver of investment and growth. So it'd be great to get that or settled in the tax.
For sure. The other thing that comes up in the real estate circles is this sort of constant potential threat to 1031 exchanges. And, I would presume that's going to be a non-issue at this point. Is that fair?
I think that's accurate. The president-elect in the campaign didn't say anything specifically about it. I think the biggest threat was always sort of originally from President Biden and then carried forward indirectly from into Vice President Harris's campaign was efforts to propose that we limit the value of 1031 exchanges to, I believe it was $500,000 of property in an effort to, as part of their broader revenue raisers via taxing the rich. But that primary threat, given these electoral outcomes, is over. It was not something that was particularly prioritized, I would say, in a lot of these debates, though it was, I believe, included in some of the Build Back Better legislation from Democrats. So I think that is still probably a long-term threat when you look at 2028, right, further later in the decade, that it could come back under certain circumstances. But it's, I would say, short to medium term, definitely not a major concern at this point.
What are your thoughts on, well, maybe you can remind people what the laws were here before, but like SALT taxes?
Yes. So prior to the 2017 tax law, you were able to fully deduct the value of your state and local tax payments, either income or sales taxes, in addition to property taxes from your federal tax. And so that, of course, reduced the amount of tax you were paying sort of on a combined basis from the state and the federal side.
Right.
Starting at the end of 2017 into the 2018 tax year, policymakers federally put in place a $10,000 cap on state and local tax deductions. That's combined all of the value of your state and local taxes you're deducting off your federal return, regardless of filing status. And that's also not adjusted for inflation. So we've had this in place starting in 2018. It does expire with all the other individual provisions at the end of 2025. So that does set up a big debate, discussion about what to do about SALT. One thing to note, in case folks didn't hear this, in a somewhat of a surprise, President-elect Trump in the campaign, in a speech, did comment that he was interested in allowing for a full SALT deduction or removing this cap, which I think brought back some air into that debate and into folks who were supportive of not having a cap moving forward. The one trade-off is it will make more expensive the rest of the bill. One reason why the cap was put in place originally was to help offset some of the cost. It costs about or raises about $1 trillion over 10 years. So it's not a small item, which is part of why people have passionate views about it.
And just for perspective too, I mean, I think one of the issues there was that if you look at like the states with the biggest taxes, the state taxes, like talking about where I am in California, New York, and these are the places where they are perennially they're blue states. And I think there was, at least initially, some sort of Republican agenda essentially to say, hey, you guys have your own big taxes on your own states, but you can't take that and then steal from the federal government because you're going to have your own taxes so high, right? I mean, that was sort of the agenda. But it's interesting to hear that Trump may be backing away from that, and that who knows, that could potentially be because I think his numbers got so much better in these states too.
Right.
So yeah.
That definitely shifts things. So you're totally right that there's a big geographic sort of component to this, and a lot of um, uh, taxpayers in certain places were impacted much more than others. One just important point, though, that's lost sometimes in the discussion is we talk about SALT in isolation. It's important to also, of course, pair it with the other tax cuts. So a lot of folks who may have seen a tax hike on a gross basis from SALT saw tax cuts elsewhere from the AMT, the rates and brackets, other things. So there were folks who saw a net tax hike. I think about somewhere around 9% of taxpayers overall saw actually a net tax hike from TCJA. So that's part of it. But for a lot of folks, it's actually netted out to be okay. But
Yeah.
we'll see if that continues. One thing we've heard on the Hill, as we talked about publicly, is maybe, and this is still early, right? But maybe the SALT cap is continued, but it's made more generous in some way. Maybe we double it for joint filers, or we raise the cap and double it for joint filers. So there is more relief without completely uncapping it and losing all of the revenue to offset the tax cuts elsewhere.
What about personal property taxes and mortgage interest deductions and things like that? That one, there was a time when these were unlimited, and so if you had a very expensive home, there was a lot of good reason to do like an interest only type debt. So, is there anything discussed about that?
Yeah, a couple of things there. So, under the TCJA, basically before there was a limit where you could deduct for itemizers, you could deduct interest associated with $1 million of a principal mortgage. That was reduced from $1 million to $750,000 moving forward prospectively. So that did limit the amount of interest for folks who have a mortgage in excess of that. I believe it's also not indexed to inflation. So, of course, as property values have risen, the folks where that's binding and tax hike have gone up over time. The other countervailing, of course, impacts that makes it a little ambiguous is with the standard deduction being doubled, the number of itemizers dropped from about a third to about 10%. So the number of folks, about 90% of folks aren't even sort of eligible for it one way or the other because they're taking the standard deduction. But this is a similar dynamic to SALT in that for the folks who are impacted, those 10% of folks in particular areas where home values are high, where their property taxes are already high and they're being harmed by SALT, this could make a meaningful difference.
Right.
I think one thing we've heard or seen more about is actually there's some interest in even going further, right? And reducing that value of that mortgage interest deduction or eliminating it completely. That's probably unlikely politically at this stage, particularly with the narrow margins we're talking about in Congress.
Yeah.
The most likely situation is continuing current policy, so keeping that $750,000 maximum associated principal amount for the interest deduction in place. The same is probably true of the itemized deductions. There isn't, won't see it good or bad, right? But not a lot of interest in completely redesigning or overhauling the decisions made in 2017. A lot of the discussion is focused on how much of it can be extended for how long, and that may include some of these offsets. But there could be some tweaks. One interesting example is, what you do with certain itemized home office expenses or deductions for employer reimbursements that were previously itemized. There's been some attention to that on the Hill. We could see some tweaks there, for example, but otherwise, the pressure is on the revenue side to how to deal with the cost of extending the tax cuts, and that's going to incentivize policymakers to preserve at least the remaining offsets and base broadeners that were in the original bill.
How about estate tax limitations? Do you want to talk about where we are, what's going on, and then ultimately what you anticipate being on the table?
Sure. Yeah. The single biggest change in 17 was a doubling of that estate tax exemption, which further reduced the number of estates who were potentially subject to the estate tax by quite a bit. So right now, I think it's sitting at it's an extra inflation. So it's somewhere, and I'm gonna have to guess for 2024 and 5, but it's somewhere in the realm of 12.5 million single, double that for joint, somewhere in the $24 million range. And that will go through 25, and at the end of 25, much like all these other things, it expires. It'll be cut roughly in half. So I think it's roughly 7 million indexed to inflation from 2017. And so that would once again bring back a pretty large number of estates. If we're going to talk about, sort of estate planning or planning on that side of things, that's probably one folks would really want to watch out for, just because the biggest risk, because Republicans are probably most likely interested in extending current policy, the bigger risk would be, is there a hole somewhere? In the small chance that they, fail to pass something in 25 and they don't extend current policy, it's possible. I don't know how likely this is, right? But it's possible that exemption amount could fall, and then it's a year later they re-extend it, right? So a state's caught in the middle if they haven't planned for estate tax liability. That could be a hit. That's just one possibility. If we're talking about planning, that would be one thing to look out for when it comes to sort of that moving forward. Of course, Republicans are interested largely in eliminating what they call the death tax or the estate tax permanently. That may be more of a lift, though they could do that on a temporary basis if they wanted to go further. That was part of the goal in 17, was to just really reduce the number of states having to deal with this. And of course, the other caveat, which is a lot of folks don't know if they're not in this world, of course, is there are estate and or inheritance taxes at the state level you still have to deal with. So it doesn't completely eliminate the issue, but
I mean, the other thing, and I don't know if this is something you've been looking at it or not, is that a major way by which wealthy individuals, even in our group, tend to try to avoid these kinds of estate tax issues is by creating various estate trusts. And I know there was sort of a little bit of an attack on a specific kind of trust known as a grantor trust, which is, sometimes when you have even offshore trusts or you have like dynasty trusts and things like that, you'll have type of trust where there's not ownership of the taxpayer, but that taxpayer ultimately is responsible for paying the taxes of that trust on a yearly basis. That has traditionally been a means by which people have been able to circumvent the estate tax laws in the past. And I know that this current administration at least took a few shots across the bow to try to eliminate that. I don't know if I summarized that elegantly or not, but maybe you can.
I think so.
Yeah.
I think that is completely accurate. What we saw was, I think a lot of folks in Treasury and at the IRS were trying to take a lot of the academic work that's been done on this to go after, grantor annuity trusts and other types of arrangements they just mentioned to close up what they would consider loopholes to the estate tax and increase the amount of revenue being raised. And that really culminated, if folks are really interested or nerdy like me, in what is known as in the Treasury Green Book, or basically a detailed set of proposals on how they would raise taxes that they delivered to Congress with the budget. There were several options in there detailing how they would go ahead and try to tighten up a lot of the rules associated with these trusts that they didn't think they could unilaterally change on the regulatory side themselves. That was very much a product of the Biden administration. It was indirectly sort of adopted by Vice President Harris, and probably would be a continued threat had Harris won the election. But given the results, it's probably something in the next 2 to 4 years that's less likely. I think one big question is, and it's a little more outside of my wheelhouse, but would be any changes that were done on the regulatory side in terms of interpretation from Treasury and the IRS could be adjusted, at least incrementally, to be potentially a little more taxpayer friendly, right? That's something that folks in this planning space probably want to look at closely. It's definitely less impactful than, say, these rules passed Congress, which the biggest threat at the time was Build Back Better in 2021, when a lot of this was actually rolled in and adopted in the House, which passed the House at the time. But since then, this stuff has failed to gain traction elsewhere. But I would say very much the intellectual sort of case for it, the work that Treasury did in the last few years, that isn't going away. I think it's going to continue to be a threat, depending on who. I think that's one big trend. Just to get a little bigger picture, is because tax policy is so polarized, like many things are across party lines. Folks have to be really sort of cognizant and aware about what that looks like in a way you may not have had to in the past, because these tax policy swings are pretty larger than they may have been 20 or 30 years ago.
If you have in a situation like that with people, because I know, again, there's people who are listening who have grantor trusts, they have dynasty trusts, they may have family trusts or whatever. If they're already in place, are those typically still in danger, or would those be would that typically be grandfathered? Would they typically be grandfathered out of any kind of new law like that?
Typically, the best practice and what we typically see in a lot of this design is prospective, meaning new trusts moving forward. That's also true of a lot of the, for example, disbursement rules related to tightening up rules for IRAs, for example, for ultra wealthy individuals and families. But I'm not sure if that's guaranteed, right? Or legally they need to do that. And so that would be something to watch closely. Thankfully, a lot of this is, and if for folks who wanted to learn more about what that threat looks like, detailed in a lot of granularity in the Treasury Green Book and elsewhere. So a lot of that can be sussed out on what that may look like. A similar threat sort of existed, and again, this is not really on the table short to medium term, in the world of changing the tax treatment of capital gains, where it's a related issue worth noting where, and this has happened in the past, where a lot of folks would, of course, want to plan for, hey, if capital gains rates are rising or other changes to, say, step up in basis are going to happen, would it make sense to realize gains now under the current law rather than the threat of a different law that might be more punitive moving forward? The trick that Congress sometimes does is they'll introduce legislation and it's actually effective the date of, not the date of enactment, the date that it was introduced. And the reason they do that is to prevent folks from seeing it and then saying, hey, I got to
sure.
So that's just something to watch out for. It's that could trip people up in the future. Not right now.
It seems to me if you're going to make some sort of move along that line for planning, do it before there's any mention of it, then your best bet. If you're thinking about doing some sort of trust estate for estate taxing purposes, which I've talked about many times on this show, by the way, then do it now. So the other thing that you mentioned earlier, which probably doesn't really affect, this group as much, but tips and overtime, how would that work exactly?
That's the question we've been asking because it's very high level, very campaign speeches, right? Not a lot of discussion at this point on the design details. So there's lots of options the president-elect or Congress could look at there. A couple things to consider. One is, and some of the restrictions on the procedural side may inform this, right? But one question is, are we just talking about the income tax or is it income and payroll tax? Matters for a few different reasons, right? It's more expensive to exempt overtime and tips from payroll tax. It affects people's ability to accrue credits for Social Security, so that would have to be either addressed or people should know that. There's other questions on, is this going to be an unlimited exemption, or are there going to be caps as it relates to income or the amount of tips and overtime that would be exempt? That would also affect the revenue and the number of folks who benefit from it. Are there going to be?
I could also see this kind of tricky thing here, like how do you define tips? Like
exactly.
What if instead of taking, several $100,000 commissions, all of a sudden it's a tip.
Yes.
Like those are and with overtime, you could design it. So pay me $5 an hour or, or minimum wage. And then after that, you can pay me the, $500 an hour after I've hit my 40 hours, right? Like there's lots of ways to manipulate this stuff.
And they're big. When you're exempting it from income tax, there's going to be a lot of incentive to do that.
Yeah.
On the tip side, there are certain ways you can do it to constrain it to just, tipped income that's ordinary and customary in certain industries, right? You could design there's some protections, for example, in the tip credit that employers can claim, right? But these are all design details that Congress needs to iron out,
right,
while simultaneously also dealing with the expiring TCJA provisions. And so I do expect that they're going to put some guardrails on this, both for the avoidance opportunities we're talking about and also to keep the cost down, because they're going to need to fit this all into whatever the top line deficit number is in reconciliation, right? Which is basically how much additional deficit increase are they willing to bear. You have to add this all together. So that the other thing they might do, and this is a little more speculative, but it would make a lot of sense, is maybe they prioritize longer term extension or permanency for the TCJA stuff, but they say, hey, for these other new tax cuts, we only do them for a few years. We mostly to see a test drive, right? Do they work? Then any adjustments? Are folks actually finding them helpful? And then it's dealt with in a future Congress. That also keeps the cost down because you're only scoring the cost when they're actually in effect. And there's others too, right? I mean, one that was maybe talked about a little less is this new deduction for auto loan interest. Something that, basic questions like, is this an itemized deduction? Is it an above the line deduction? Are there going to be other guardrails on it? Unclear, right? And so that's going to be additional work for Congress, depending on how, the president-elect's going to have a lot of, and his administration have a lot of leeway on how hard they push, what their red lines are, what they want to see in that.
Yeah, makes sense. Last question for you, and this relates also, I guess, in part to Elon Musk's Doge committee, right? We had a podcast on this recently. What do you think is going to happen with the IRS?
That's a good question. Yeah, there's been a lot of interest in, hey, could we, particularly amongst conservatives, about moving to a flat tax or radically reforming the tax code to simplify things and even eliminate the IRS. That might be, um, uh, folks maybe find that a worthwhile goal. It is challenging to do because you do need an administrator of some sort, even for the simplest of tax systems. We're big fans of the Estonian tax system, which does have a tax administrator, but it's much smaller than the IRS, even controlling for the size of the country. And so there's definitely a lot of efficiency opportunities there for the IRS.
Have you heard of anything specifically? I mean, because we're coming off an administration basically that had the opposite view, right? Of really like expanding the number of employees and the funding for the IRS. I mean, this seems like a radically different administration when it comes to not only specifically as it relates to taxes, but just bureaucracy in general. And then on top of that, obviously taxes themselves. So have you heard any specific agenda from incoming administration types?
I haven't heard a lot of focus on that from folks associated with DOGE or from the administration, though I think it is fair to say, and this is true, I think a theme amongst Republicans has been that there's been too much of an emphasis on the enforcement side, on the stick from the IRS on the part of taxpayers at a time when taxpayers are skeptical of the IRS, lack trust in it for better or worse. And so shifting that from the stick side to how do we actually get our taxpayer services back to where they should be, at least to pre-pandemic levels, which are not quite there yet. How do we adopt there's just a laundry list of reform recommendations from both the National Taxpayer Advocate, the Government Accountability Office, from inspector generals to help make the IRS more transparent, more taxpayer responsive, less bureaucratic, that haven't been gotten to yet. And a lot of that is, again, for better or worse, been distracted by the enforcement side. And of course, we always hear about tech modernization, which has been the agenda of the IRS for decades, but hasn't really moved forward in a way that's been translated to better outcomes. How do we, I guess in the theme of DOGE, right, is how do we break through that, right? What is the actual answer there? Is it a downsizing? Is it a sort of thinking much bigger picture about the design of the IRS? That's a hard problem to solve, but that's probably where the focus will be to make the IRS a more responsive and trustworthy agency. There's of course going to be, and I think it needs to be said in this kind of conversation, right, concerns from Democrats and others about will the IRS be politicized in that broader context. So we don't want to go in the other direction, right, of, hey, people were worried about the IRS being politicized under Biden. How do we make this credible, neutral arbiter that gets its job done is probably the place to focus on, but I'll have to see if that's the direction they decide to go.
Fascinating. Okay, well, Garrett, I could talk to you for another hour here and just keep going, but I know at some point we got to stop. And interesting stuff. How can we learn more about your work?
For sure. Feel free to visit taxfoundation.org. We have a variety of resources, both on the educational side on how the tax system works, as well as ideas on how to reform the system from being fairly incremental to wide-ranging and sort of a big reform. We work not only at the federal level, we also work at the state and international levels as well. We have a variety of visualizations and maps. Our big focus is on making the tax system and tax policy accessible for everyday folks not in it. So we have a variety of resources. You can also find me on X at @GS_Watson.
Great. Thanks so much for being on the show.
Thank you.
Welcome back to the show, everyone. Just a reminder too, just speaking of taxes and all that stuff, a big focus of our investor club is tax mitigated type of real investing. And so if you're talking about trying to take advantage of some of the bonus depreciation and things like that, make sure if you're an accredited investor to go to wealthformula.com and sign up for Investor Club. Especially towards the end of the year, we have some real opportunities if you're looking to potentially save on taxes. And of course, those might even be better than they currently are because of the fact that you just heard bonus depreciation may actually go back to 100% in the rears. So that's it for me on this episode of Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, Consult your own financial team before making any investment. See you next time.